Hello, happy summer to everyone, and welcome to our latest update. I'm William Danibale, Managing Partner of American Retirement and Investment Strategies. As you can imagine, the word recession is on everyone's minds these days. And given the high inflation momentum, the market taking a dive, and the Fed turning much more aggressive with high rates, we thought it would be appropriate to make a short video on where we stand with the recession and bear market, what it means to investors, and the implications to portfolios as well as different asset classes. So based on different estimates from economists and analysts out there, we have a 55% chance that we will have a recession in the next 12 to 18 months or so, versus a 45% chance of a soft landing. What is a soft landing? It means that the Fed will raise rates, but the economy will not go into a recession. Obviously, things have changed dramatically with the Fed doing in hawkish pivoting over the last couple of months and started raising rates by the tune of 75 basis points twice already. That's 0.75% twice, trying to cool off the economy and keep the inflation under control at the same time. Just a little premise though about corrections, that is when the S&P index goes down by 10% or more, and bear markets, that is when the market goes down by more than 20%. If we look at history of the past 100 years of the stock market, we have had 53 corrections so far. That means the market went down over 10% on average every 2 years. And over the last 100 years, the stock market has had 16 bear markets, that is down by more than 20%. Meaning on average, every 5 or 6 years or so, we experience a bear market. So these are just natural cycles that are part of the stock market world. People that do not understand this, or they panic when these cycles happen, should not be in the stock market at all. When I ask to a group of people, I do this quite often, to raise their hands if they are short-term traders or if they are day traders, nobody raises their hands. Everyone is a short-term investor, though, when the market goes down, either 10% or 20%. That's when the emotions take over, and that's when big mistakes are made all the time. We learn from history that the stock market always rebounds, sometimes quicker, other times slower, but we always march forward and we go higher. But what is exactly a recession? Contrarily on what most people believe, 2 consecutive negative GDP are not necessarily the formal definition of what a recession is. And incidentally, this morning we just got the second quarter GDP negative that adds up to the first quarter of 2022, which was also negative. So most people think now that we are officially in a recession. According to the National Bureau of Economic Research, the NBER, which is the official arbiter of U.S. business cycles and recessions, they define a recession as a significant decline in economic activity lasting more than a few months, normally visible not only in the GDP growth, but also in the real income, unemployment, industrial production, and wholesale retail sale. If you look at the middle of the chart here, you can see a number of components that the NBER looks at, and only one of these components is really flashing a recession. Consumption is still at very healthy levels. Payroll and personal income are at peak levels. So you might hear a lot about being in a recession already, read it probably in every newspaper that you open. But if we look at the data, and especially at what is important to the NBER, clearly we are not in a recession yet. So what caused the Fed to pivot so suddenly and focusing solely on bringing down inflation, including the risk of causing a recession. We need to look at two pieces of data. The first was when the CPI, the Consumer Price Index, came out in May, showing how inflation was accelerating higher than the consensus forecast. The second piece of information is the chart you see here on the right side. The University of Michigan came out with their consumer confidence and long-term consumer expectation for inflation, which moved up in a dramatic fashion. And this is exactly what happened in the 70s, when the consumer expectations moved higher and the Fed then was very reluctant to be aggressive with the rates. Obviously, Jerome Powell, the chairman of the Fed today, doesn't want to replicate the same mistake twice. Because of these two pieces of data, the Fed pivoted in a hawkish way and started to raise rates in a super aggressive fashion by the tune of 75 basis points. That is 0.75%. And until we don't see sustainable signs that inflation is under control, or that is at least changing the trend, the Fed will remain aggressive, which obviously is not good news for most financial assets. And when you go from 0% to 3.5% in the same year, like today, we think it will be very difficult for the Fed to fine-tune its policy gradually. And let's not forget that in addition to the rates increase, the Fed is also eliminating quantitative easing, meaning it's not buying bonds in the open market anymore, therefore not injecting all that extra liquidity that fueled the market for 10 years or so in the background. As we all know, the stock market is a discounting mechanism, trying to digest and calculate probabilities about 6 to 9 months ahead of actual facts. That's the reason why it has a tendency of rallying higher in the middle of a recession, because it has already priced in all the negative news of a recession and is now looking ahead. The current bear market has been doing exactly that, trying to metabolize and price in the possibility of an economic downturn and possibly a recession as well. And although this recent sell-off has felt very severe, historical bear markets tend to last longer. In fact, the average bear market is around 16 months, with even deeper drawdowns, around 35% on average. This has only been 7 months so far, and the S&P has touched the bottom at 23.5%. Every bear market has always had two components. First, we have the contraction in prices, which has already happened. Secondly, we have the contraction of earnings. And if we look at the last year markets, the average ratio of price over earnings, the so-called PE, has been around 12%. And we are coming down fast now, very close to that number, which is definitely a good sign that perhaps the worst is over. And if we have to go down again, in prices that is not going to be much far away from the lows that we experienced in June. Now, regardless if we will have a soft landing or a recession in the next few months, the fact that equities have had such a steep sell-off so quickly, entering a bear market, meaning a 20% decline in the S&P 500, that has historically represented a great entry point to deploy capital for long-term investors. So, looking at all the bear markets for the last 80 years, we looked at how equity markets do the moment they hit the 20% negative with the S&P 500. On the left-hand side of the chart, the average is the S&P falls another 15%. That's the purple bar. Or another 17.8% during recessions, gray bar, and a little more than 11% in a non-recessionary environment. But if you had bought equities the day of when the market hit the negative 20%, 6 months later, on average, in purple, you will be up 4.1%, and 12 months later, you will be up almost 12%. In a recession, you're up 9%, and in a non-recession, you will be up 17%. So, even though we could expect more pressure on the downside from here, the long-term forecast looks very favorable now. The risk-reward is now starting to stack in our favor. And because nobody knows when a low of the market is finally formed, that explains why a dollar cost averaging from here on is probably one of the best strategies to use capital in the market in the next few months. Another reason to be optimistic is that when the consumer confidence is low, that usually represents another great entry point in the market. So this chart here shows the University of Michigan Consumer Confidence Sentiment Survey. And whenever you get to a very low point, you look a year after that reading, and the S&P 500 has been up on average a very nice 25.6%. And if you look at this chart closely, you will notice how consumer sentiment is at the lowest level ever in over 50 plus years. Again, this could be a great opportunity to re-enter the market gradually from here and be optimistic for the long term. So, where are those opportunities in the market? Well, it depends on what your views are with the recession. Since 2005, what has worked really the best each time the market declined by more than 5% have been large cap growth companies. But during this 2022 sell-off, we have seen that value companies are the ones that held their ground much better. Now, if you think inflation is going to be stickier and be around for longer than expected, then you want to overweight value companies in your portfolio. But if you think the Fed will ultimately succeed in controlling inflation, and even if it creates a mild recession with higher rates, which is where we believe we'll end up to, you might want to be in large cap growth. Independently, if you are in the camp of a recession or not, there is one asset class that will undoubtedly do well. It's the dividend grower stocks. As you can see from this chart, dividend growers outperformed prior to the first rate hike, after the first rate hike, and if you look at the entire rate hiking cycle, dividend growing stocks outperformed by 2.5% on an annualized basis on average. When we talk about dividend growers, though, we want to focus on quality companies with clean and strong balance sheets, so they don't have to access capital markets for borrowing needs. Companies that generate tons of cash flows. And ultimately, companies that keep rising their dividends will effectively cancel the negative effects of higher interest rates, if you really think about it. I'd like to finish this presentation with this slide, which shows how we still believe we are in the middle of a secular bull market, which usually goes on for roughly 20 years. So we still have plenty of years for going higher here. But if you look at that box underneath the chart, that will show you how deep the sell-off will be in a secular bear market or during a secular bull market. As you can see, there is a big difference. And this is another reason to be optimists in the sense that we are very close to the bottom here. And with that, I'd like to thank you for your patience and your trust as usual. Joe and I take both of them very seriously and appreciate your confidence in us. So until next time, stay safe, stay cool, and enjoy every single day.